skiing.
I'm supposed to go next weekend, Thanksgiving weekend, but we'll see.
Skiing?
Yeah, we'll see
In
how
Austria?
much. No, not in Austria. In California. We'll see how much snow there is. No, if I was going to Austria next week, I'd be very lucky that I was leaving this country.
Yeah,
I would not come back.
They would like to in actually.
Huh?
They won't let us in.
No way,
They're
right?
locked up right now.
My uncle lives in Hawaii, and he left his house for the first time last week. He's been there since March in his house.
Good morning.
All right, let's get started.
I think it's a little silly.
So, I want to kind of test out your skill sets by kind of introducing a couple of things into our analysis. So most of this you've sort of done, but we're going to twist it and turn it a little bit differently. So let's start out. Here are, it looks like 1, 2, 3, 4, 5, 6 variables, and then we're going to calculate the 7th, or the before tax internal rate of return percentage. So let's just start out. Purchase price for a property, give me a dollar amount. $1 million. Oops, let me write down $1 million. All right. Loan to value ratio.
27.
What?
27.
27. No, let's pick something a little bit more. 75%. Okay. The interest rate on an interest-only loan? 6%. Okay, and we're going to go with a 5-year holding period. Just because I don't want to have to write the numbers down for 10 or 15 years. All right. Stabilized net operating income, let's say, based upon a purchase price of $1 million, around, let's see, 75,000, roughly. And then when we go to sell it, the residual cap rate that we want to use, let's go with 4%. And so there we are. Okay, now here's what I want you to try to do on your own. Using those variables, figure out how you would set this up and then solve. Okay? You know it's going to involve a little bit of cash flow, but it's going to be on an annual basis, so it keeps it pretty simple. You know that if you're solving for the before tax internal rate of return, then what are you using as your cash flow? What line item? Okay. What line item? If you're
Equalized.
no.
You would be using your debt service subtracted by your NOI.
Or what do we call that? Our before tax cash flow.
Before tax, yeah, before tax cash flow.
Okay, so in other words, once again, we kind of start out with potential gross income, we subtract out vacancies, collection losses, we add in other income. That gives us effective gross income minus total operating expenses, which gives us NOI, subtract out annual debt service, and then that is what gives us before tax cash flow. But all we're given in this problem are basically your NOI and your annual debt service, meaning that you're going to have to calculate before tax cash flow. Okay? All right, get to it. I'm going to give you 5 minutes to see if you can get it on your own. And as an incentive, if you can get the correct answer, well, I can't do that because I won't have any way. I was going to say, if you get the correct answer in 5 minutes, you're exempt from today's quiz, you get a perfect score, but I'm not going to do that because there's no way to be able to police that in the sense of ensuring that you're doing it correctly. Okay, when you think you've got the correct answer, let me know. Okay, I'm going to start pointing you in the right direction, but here's the thing. If you're not able to almost instantly attack this problem and instantly figure it out, I mean, I don't know even what to say, because this is, you know, fundamentally what this class is all about. So let's take a look at this. All right. So we start off with our purchase price of $1 million. Our loan to value is 75% of that, meaning that our loan would be $750,000, okay? And the interest rate on that loan is 6%.
So far,
Which then
45,000.
would be 45,000 as our annual debt service, okay? All right, so given that we've got that, then what you're going to do is, if you say net operating income is 75,000 and annual debt service is 45,000, then we're left with 30,000 as a before tax cash flow. Okay, everybody get that? All right, now, okay, so let's take a look at what the cash flows are going to look like. All right, so if we've got your 0, 1, 2, 3, 4, and 5, okay, so we know that our before tax cash flow is going to be the annual operating income each year, so we can go ahead and write that down. Okay, now let's go ahead and take a look at our residual here. Oops. Okay, so we know that in the 5th year we're going to sell the property, all right, and we're going to sell it based upon a 4% cap rate of net operating income. Okay, so our net operating income is staying constant at 75,000. So if we simply take 75,000 divided by the cap rate of 4%, that means we would be able to sell it for $1,875,000. Okay, but we have to pay back the loan of the money that we borrowed. So the amount that we borrowed was $750,000. So that leaves us with $1,125,000 as the money that we will be getting as part of the reversion. Okay, on a before tax basis. Does everybody see that? Yes or no? Okay. All right, so added to that last year's cash flow, just to go ahead and put the number in there, then that means that our final year cash flow would be the $1,155,000. So those are going to be those cash flows. Okay, now, at time period 0, what is going to be our cash outflow? Now, before you answer, make sure that you're thinking about this, because we're looking at this from the equity investor's perspective of the amount of equity that they put into the project, therefore equity in, equity out. So they borrowed 75% of the $1 million, meaning what was their equity investment?
250.
$250,000. Okay, so $250,000 is going to be the initial cash outflow. Okay, and once again, since we're doing this on, this is all one payment per year, so we can kind of write that in just in case you didn't do that already, but one payment per year. And once you've got all of that, then you should be able to solve for the internal rate of return for that property. So let's do that, see what we get. Okay, 42.5%. Okay, now, how or why did we score so big on this project? What was really the big thing that helped us tremendously?
Interest-only payments?
No.
Cap rate?
Yes. Because the cap rate that we sold this thing for was incredibly low, therefore our residual value was jacked up really high, okay? So, you know, if we had had a substantially higher cap rate on the residual, that would have lowered dramatically our resale price. I mean, just think if the cap rate had been double that. Let's say the cap rate had been 8%. What would that have done? Okay, 75,000 divided by 8%. That would have lowered our resale price down half of this, basically, to 937,500. Then we would still have to pay back our loan of 750,000, and that would have only left us with about 187,000 as our residual here that we would have put in, that we would have received. So that would have dramatically lowered our rate of return on the project. So the point is, we scored, and we scored big because of the cap rate. Okay?
But that cap rate is something that we deliberately put in, no?
Well, we put in the sense that
No, I mean, isn't that like a value that the investor says this is what they want to achieve?
the cap rate is based on the market, okay? And so the market dictates the cap rate, okay? And it just so happens we got lucky, timing-wise, that the cap rate for this particular product was really low, okay? Meaning that we would get a high price for the income the property is generating, okay? Now, if we're a buyer, we would look at that totally the opposite, okay? But as the seller of the property, this works and works well for us, okay? I mean, if you're a buyer, you want to buy, obviously, at a much higher cap rate, but if you're a seller, you want to sell at a low cap rate, okay? All right, does everybody understand the process of what we just went through? Yes or no? Any questions about the process that we just went through? Okay? All right, so if that's the case, so basically that's question 1 on the quiz, all right? Question 2 on the quiz is a little minor modification to this. And the minor modification would be, assume that your net operating income grows by what percent? Give me a percent.
2%.
How much?
2%.
2%. 2% per year. Okay? Now, what I want you to do is resolve the problem, making that one adjustment. At first, you're going to think it's super easy. It's not.
Because every year the number changes.
Every year, the number's going to change. Now, I want to see how many of you make the most common mistake. So go ahead and work it out a little bit. And let's see how many of you are on the right path versus the wrong path. I'm going to give you about another minute just to see if you're approaching it correctly. Because my suspicion is probably about half of you are going to approach it wrong. So we'll see.
Fred, I just sent a private message.
I don't even know if I, let's see, can I get private messages? Oh, this would be hard.
You just change the reading. You just multiply 3 times 2% and add it to it.
Yes, is the answer to your private message.
It's going 2%.
Every single time. So you just add it and then you do the math. I'm ready to just like build shit, you know? I already do build shit.
Okay, here is where I think most of you are going to probably make the mistake. You are not adjusting the before tax cash flow. You are adjusting the net operating income, okay? That is the most common mistake because many of you are probably saying, oh, I'm just going to take the $30,000, multiply it by 1.02 and get that. That is not right. That is adjusting your before tax cash flow, not your net operating income. So what you got to do is you got to go back up to your stabilized NOI, which is 75,000. Okay, so in year 1, it's still 75,000. In year 2, however, it's going to be 75,000 times 1.02, or 1 times itself plus the 2% growth rate,
76,500.
or 76,500. The following year, you'll take the 76,500, multiply by 1.02,
78,030.
78,030, rinse and repeat,
79,590.6.
okay? And we're going to go ahead and do it for year 6 as well. And I'll explain that here in a second. Okay, so those are the adjusted net operating incomes for each of the years. Now, we've got to still subtract out our debt service for each of those. So our debt service is staying constant at the 45,000. So for each of these, we'll kind of try to keep it somewhat organized. So 45,000 minus 45,000 minus 45,000. Okay, somebody needs to turn off their microphone because I can hear what sounds like car noise in the background. Okay. So, subtract out our annual debt service from each of those. that would be our adjusted before tax cash flows, okay? All right. Now, if we kind of go back up here to the previous problem, our equity hasn't changed, so it's still 250,000. Yes? Yes?
Yes.
Okay. So if we look at it from that standpoint, we can, if we want to, here, if we sort of say this is, once again, time period 1, 2, 3, 4, and then 5 is not yet complete because we've got to add in the residual. But time period 0 is going to still be the 250,000 of equity that we put in. All right, now, for the 5th year residual. All right, if you remember from our discussions, what do we typically do? If we say the property is sold at the end, in this case, end of the 5th year, what do we use as our NOI to calculate the residual?
Year 6.
Year 6, because keep in mind, what you're doing is you're looking forward in time and saying, okay, what is going to be basically the NOI for next year predicted, therefore you're going to use year 6 NOI and then apply whatever cap rate that you've been given. So we're going to stick with the 4% cap rate, but what we're going to do is we're going to take the year 6 NOI and divide it by the cap rate of 4%. So it's even going to give us a bigger wallop. 2,070,151.50 as the residual value. Okay. Does everybody follow that? Yes or no? But what do we still have to do to that number? Just like we did in the previous one.
Deduct what we owe for debt,
Yep.
our debt service.
We still have to pay off our loan. So we got to subtract out the $750,000 loan. So we are left with $1,320,151.50 as the amount that we are going to receive in that year, okay?
That's the residual value.
So that is going to be added. Okay. So the total amount, whoops, yellow. Oh, come on.
1,356,333.9.
Seriously. Why does this do this to me? Okay. So that's going to give us 1,356,000. 333.91. So that will be our cash flow for that year. All right, so all the others, kind of erase all that stuff and just put in cash flow here. Obviously that's going to be a negative. Cash flow here. Okay, once we've got all that, then solve for the internal rate of return. Let's see what we get. I get 47.05%. Okay, you guys matching up? Okay, good? All right. So that's basically question number 2. Okay, question number 3 is 40, the answer was 47.05.
Okay, thank you.
Okay, so for question 3, we're going to get back to something we talked about last week about the promote. Okay, so this example that we just gave and the one right before it, this is in essence, you know, you're the investor. Okay, you bought the property, here's what you paid for it, here are the returns you got, and so forth, so on. Okay, now let's flip the script a little bit, and let's say that you do have a developer associated with this project. And whatever you paid them, you know, in terms of a developer fee or whatever, let's just assume that's kind of already embedded within the operating cash flows. So we're not going to complicate that. But what we are going to do is we're going to make the assumption that we're going to pay the developer a percentage of the capital gain associated with the property at the end of the 5 years. Okay? So for this project, let's sort of step back here for a second. And let's start with the fundamentals. Okay? So based upon this second scenario, our selling price at end of year 5 is going to be equal to the $2,070,151.50 that we got from up here. Okay? All right, so that's what we're selling it for at the end of year 5. All right, we purchased it for $1 million. Okay, so let's sort of just subtract that out. And so we should end up with $1,070,151.50 as our capital gain. Okay? Everybody good with that? Yes or no? Okay? Now, the question is, how much of that capital gain do we, as the investor, want to give away? Well, the simple answer is none of it. But assuming that the developer demands that we give them, you know, some piece of the pie with regard to the upside on the valuation of this property. So let's just say that we're willing and we're super duper generous on this, and we're going to give the developer a 40% promote to developer off of that capital gain. So what that means is out of that $1 million, 40% is going to go to the developer, meaning we're not going to get it as the investor. Okay? Is everybody with me? Yes or no? Okay, so if that 40% promote goes to the developer, they're going to walk, the developer is going to walk away with $428,000. Okay? Meaning that obviously the investor is keeping the other, what, 60%. Okay? Now, the question is going to be, what is the investor's revised rate of return as a result of having paid that promote? So in essence, what you're going to have to do is kind of go back up to our calculation up here, where we've got, okay, this is the original selling price of the property. We had to subtract out the loan. Now, we have to subtract out the developer's promote from that to see what we actually walk away with as the investor. So we would walk away as the investor with 892, 090, 90. Okay, so what that means is then we've got to go back up here and resolve, but what we're going to be doing is basically replacing that number, which was this, with the amount we're now receiving, which is the 892, 090, 90. All right, everything else is going to be able to stay the same. You obviously got to revise that total amount there, and then revise the internal rate of return. Okay, does everybody see that? So all we're doing to the problem is let's make sure the scenario is set up correctly in your mind, is we're basically saying, all right, we've done this deal, we want to ensure that the developer is going to do everything that they can to maximize the value of the property whenever we go to sell the property at the end of 5 years. Okay, so we want to truly incentivize them, and so what better way to incentivize them than give them a big piece of whatever the capital gain is on the property. Now in this case we're probably going a little bit overboard with 40%, but I thought, what the heck, okay, we've got some big returns that we're getting already. So in this case, by giving them that 40%, that means that we, as the investor, are going to walk away with less money than we would have. Therefore, our rate of return is going to go down, okay? Because we're obviously giving up some of that money to the developer. So let's go in.
The question is, what is the capital gain for the investor, or what is the...
No, the question would be, what is the return for the investor, assuming you gave out a 40% promote to the developer on the capital gain? All right, so in this case, if we add together the 36,182, 41 of the before tax cash flow for year 5, plus the 892, 090, 90. So what we end up with in terms of the total amount for that 5th year for the investor has now been lowered to 928, 273, 31. Okay, so now it's just a matter of re-putting those back into the calculator. Okay, all right. So real quickly, you should get 37.4647. I'm sorry, 37.47. Okay, just double check.
Yep.
Okay. Okay, you're about in Zoom land. I'm seeing a few bobbing heads, yes and no, or yes. Okay, good. All right, moving forward. That's basically question 3. All right.
Again, 30, what did you get? 37.46? 47, okay.
Yeah, well, rounded, 47. Okay. All right. Moving forward. All right. So in this case, let's say that we've got a couple of different portfolios. We're changing gears now, a little bit of a different set of calculations. So we've got portfolio A, portfolio B, and let's say our purchase price and then we're going to have our annual income, which we're not really saying what kind of income it is. Could be NOI, could be before tax cash flow. That's kind of just doesn't really matter at this point. And then we're going to say our sale price. And then we're going to look at, okay, our holding period. Once again, we'll keep that consistent at 5 years. All right, and let's go from there. Okay, so give me a purchase price.
5 million.
5 million.
2 million.
Okay, I heard 5 million. So we're going to make the assumption that for both of these, it's going to be the same purchase price. Okay. And let's say that our sale price on this first one is going to be 5 million as well. All right. But our annual income, let's say, is going to be 750,000. Okay, so let's just start off and figure out what is our rate of return on this first one. Okay, so it's basically present value, payment, future value, term, nothing more. Solve for the rate of return. So let's start with that. And we should get 15%. Okay. Okay, and let's say on this one, we actually get $1 million each year. And our future value or our sale price is going to be $3,314,404.69. calculate all that out, you should end up with 15% for it as well. So let's double check, make sure.
Where do you get the 3 million from?
I gave it to you.
Oh.
Okay, these are my match. All right, now, that wasn't the question. That's basically the information that you need for the question. All right, think before you answer the question. Which of these two portfolios of properties has the highest risk? Which of these two portfolios has the lowest risk? Think before you answer. Which of these? Okay, once again, the question is not meant to be a trick question, but some people might make it a trick question. But the question I'm asking, which portfolio has the lowest risk? Which one has the highest risk? And then why would that be the case? Okay.
Portfolio A has the highest.
Okay, hold please. Okay, so just to take the quick little poll, okay? Let's kind of go down here just for a second. A, B, let's say low, high. I'm going to take up, this is the poll. This is not the answer. This is just a poll to see how each of you are sort of responding. Okay. How many of you are saying that portfolio A has the lowest risk? Anybody? No one. Okay. So 0 is what we have there. How many of you say portfolio A has the highest risk? 1, 2. Anybody else? 3, 4. Okay. The others of you fail because you didn't answer the question. Okay. So once again, I'm going to ask. You have to answer one or the other. All right. How many of you say? I'm going to erase the answers. How many of you say portfolio A has the least amount of risk?
I see that.
Okay, I'm seeing 3 people.
I say A.
Okay, I'm hearing 4 people. Okay, how many of you say that portfolio A has the highest amount of risk? 1, 2, 3, 4, 5. Okay. All right. Your answer should be just the opposite for the other. All right, so just let's see. Okay, portfolio B. How many of you say it has the lowest amount of risk? 1, 2, 3, 4.
Me.
Somebody, okay. And how many of you say portfolio B has the highest amount of risk? 1, 2, 3, 4, 5. I'm seeing about 5 people, so a few more people, or one more person voted. Okay, now, so roughly half of you are right, half of you are wrong. Okay? Now, let's take a look at why it is what it is. Okay? Both of them have the same overall rate of return. If we were just judging on the rate of return and nothing else, they would be equal. Okay? But we're not. Okay? Because we have to factor in other things. Okay? Well, the only other things that we can factor in are the variables that we have given. Well, we paid the same amount for both of them, so that's not a difference. We held both of them the same amount of time, that's not a difference. So what is a difference? The annual income and the sale price. Okay? I'm a little bit disturbed that anyone would have said that A is the lowest risk, because it is not, okay? A has the highest risk, okay? So obviously that means that B has the low risk and is not the highest risk. The question is now, why? Okay, well,
Making our money.
what's different is that with B, number one, you're getting more sort of money, but you're getting it quicker, okay, with B. In other words, as the owner of the property, you're getting $750,000 a year for A for 5 years, whereas for B, you're getting $1 million a year. The return overall, yeah, is the same. That's not what we're concerned with. What we're concerned with is how quickly are we basically getting paid back. And from a risk perspective, would you prefer to wait a long time for your money, or would you prefer to get it now? You would prefer more than likely to get it now, simply because you don't have to then worry about it. You don't have to worry about what the exposure is going to be, longer term in the future. So the point of this problem is to get you to obviously start thinking correctly, and half of you are thinking correctly, the other half of you are not thinking correctly as it relates to this, because the reality is B would be the preferred deal. You has the lowest amount of risk, okay? We could care less in this particular scenario that it's selling for less 5 years from now. That's basically immaterial to us. What matters is our rate of return is good, but we're also getting our money quicker. Now, if you want to just do nothing but just simple math, okay, ignore time value of money and just do the simple math of basically adding the numbers each year. So for example, we've got, in this example, 750,000 times 5 years of receiving that. That's $3,750,000 of operating income plus the $5 million sale price, which would give us a total of $8,750,000 of just cash money coming in the door. Whereas over here, $1 million a year for 5 years would be $5 million of total income plus $3,314,404.69, which would be $8,314,404.69. Now, if you look at that, you'd say, hey, I'm getting more money with A than I am with B. But you're having to wait substantially longer to get that money. And in the world of time value of money, that does matter, okay? So, for those people that just want to say, yeah, I want to just get more raw cash dollars, A would be the winner. But if we have to sort of say, this project bears, or each one of them bear a 15% sort of discount rate, or 15% expected rate of return, that means there's a fair amount of risk involved with these two different portfolios. Therefore, we would prefer to get our money as quickly as possible and, in essence, take a little bit of a discount on the total amount we're receiving because we're getting our money sooner. Does that make sense? Yes or no? Okay? Thoughts, comments, observations? Okay? Moving forward. All right. So basically the problems that we just worked, for the most part, those are out of chapter 20. Okay, now we're sort of switching to chapter 21. All right, so this chapter, along with a handful of things, primarily deals with sort of portfolio management, but more specifically, dealing with real estate investment trust. And so we're going to spend a little time talking about what real estate investment trust, and then we'll kind of come back to this first little problem. All right, so as we have talked about in this class a little bit, and you're going to hopefully get much more exposure to this as you get into the forms and types of ownership structures in the real estate law course, and then also being able to ask questions of Professor San Miguel in the real estate modeling class. So David Weitzman teaches the real estate law class, San Miguel teaches the modeling class next semester. One of the things that many people don't really grasp is the importance of how your business is organized. And how it is organized impacts how it gets taxed. Okay? And if there's anything that hopefully you've begun to sort of pick up on, is depending on how you do certain things, that can have an impact on your tax liability, meaning how much you pay in income tax. Now, let me back up from that statement and say something else. Don't ever pursue a real estate deal or an investment deal simply because of the tax benefit associated with it. In other words, it should be fundamentally a good deal before you apply whatever the tax implications are to the deal. Does that make sense? In other words, here's what I'm getting at. Over time, as tax laws have changed, they have made doing business one way not as cost effective as doing business in another way because of just simply a tax law change. Because in many cases, whether it's the federal level or it's the state level, even the local government level, as it relates to real estate, tax law changes will impact what people potentially do, their behavior, because it may make it more advantageous for them to own a property or continue owning a property than to sell a property. It may make it more advantageous for them to rent it out as low-income housing than market-based housing. It may make it more advantageous for them to renovate a historic building than to build a new building in its place. Tax laws can influence behavior in a lot of different ways. Okay, is all I'm trying to say. Now, as it relates to ownership structure, fundamentally, whenever you go to invest in real estate, you've got a variety of options at your disposal of how you can basically own that real estate. fundamentally, one is to structure yourself as a traditional corporation, what we would call a C corporation. And we talked a little bit about this, in the previous week. The problem with that is for that traditional corporation, I'm going to write some of this out. It's not necessarily going to help you with the quiz, but nonetheless. So we've got traditional C Corp. Here, whatever money that you make, let's say that the C Corp, let's say the income, taxable income, is, let's say, $100,000. All right? Now, you've got a couple of choices with that taxable income as a C Corp. You can retain earnings, meaning you keep all of that money within the corporation and you don't pay it out to anyone, okay? You keep it within the company. In other words, you can have retained earnings. Or dividends. Okay? Retained earnings means that you would keep all of that $100,000 within the corporate ownership, and so all of that taxable income would be here in retained earnings, meaning that you would be taxed on that retained earnings according to whatever the corporate tax rate is, okay? So in this case, let's just say that corporate tax rate is 35%. So you'd have $35,000 of taxes payable on the taxable income. Does that make sense? Okay, and that's with $0 paid out in dividends. Okay, now let's say under the second scenario, you still have $100,000 of taxable income, and you as making that sort of decision to pay out, let's say, all of it in dividends, you think that you are going to somehow bypass the tax on retained earnings. No, what happens, well, first of all, let's just go with the dividends. Okay, you're paying out $100,000, all of your earnings, all of the taxable income to your shareholders. So they pay whatever tax, but it's on them. Okay? In this first scenario, the shareholders would not have any taxes due. Does that make sense? Because they're not getting any money. Okay? The second scenario, the shareholders, if they got paid and you had $0 in retained earnings, and the shareholders, let's say that, I don't know, their tax rate is 28%. Then $28,000 would be the taxes payable by the shareholders. But this is where it gets weird. The IRS says, well, that's fine that you paid out all of your taxable income, but we're going to still tax you at the corporate level, and it may be, a slightly different tax rate. It might be the same, but let's just say still 35% on the taxable income, meaning that for that $100,000 of income, the corporation got taxed 35, the individual shareholders got taxed 28, meaning the total bill would be what? 63? Okay, so here tax bill was 35,000. Here the total tax bill is 63,000. So if you were the corporation, given that particular scenario, that particular setup, what do you think you would probably choose to do?
Go with the first one.
Go with the first one. Because you would get to then, you would keep that money internally, you wouldn't be paying out anything in dividends, and therefore you reinvest, you're able to reinvest that much more back into the company, and the idea is continual growth and expansion, yada, yada, yada. But you may have shareholders that are saying, hey, we want to get paid something for owning your stock. So the only way the shareholders can make any money off of this first scenario is if they sold the stock, okay? Owning the stock doesn't make them any money except on paper. Does that make sense? Because the stock price would probably go up as a result of continually reinvesting in the company. But in terms of them getting money, in terms of being able to pull money out, no. That's why that, once again, the second scenario, you have the shareholders and they're saying, hey, we want dividends, we want to get paid. Well, you pull the money out, and then the corporation suffers because they have to pay the tax on that earnings, and you have to pay tax on the earnings. So, in essence, think of it like this. Since we're using nice round numbers, you've got an effective tax rate of what? 63%. Okay? You're giving away almost, you're giving away obviously almost 2/3 of your income just in taxes. Okay, does that make sense? Conceptually, yes or no? Now, so what I'm trying to do here is to wake you up to the reality taxes matter. Ownership structure matters, okay? Because if your objective is to try to minimize your tax liability, probably one, if you're talking about ownership of a lot of assets, is to form probably some form of partnership. Okay? And a partnership means 2 or more people. Okay? Can't just be a one person, that would be a sole proprietorship. A partnership, 2 or more people, pretty simple to form, and there, the partnership, let's say they had $100,000 of taxable income. Well, here's the thing. Partnerships, while they can retain earnings, and let's say they retained $100,000 of their earnings and they didn't pay out anything in dividends, the reality is the only 2 or more people that are involved in this are just the actual partners, okay? And as such, the partners don't get really taxed at the partnership level. They still get taxed at the individual level, okay? So even though they may keep, $100,000 in retained earnings, what's going to happen is that you may have partner A getting 50% or $50,000, partner B getting $50,000, but if partner A is in a 28% tax bracket and partner B is maybe in a 38% tax bracket, each of them are going to be paying 2 different amounts on the same income simply because of their individual sort of tax, marginal tax rate.
So is a partnership closer to S corp?
We're getting there.
Okay, gotcha.
Okay, so here your total tax liability would be somewhere, let's just say, for the entity, the partnership, overall, all the income would be, let's say, $33,000. Okay, so right there, obviously, winner, chicken dinner. Okay, it's great. Now, the problem is with partnerships, you don't have as many legal protections against basically people suing you as you do with corporations. With corporations, if you're a shareholder in a corporation, your liability as an individual shareholder is limited to the amount that you personally have invested in that corporation in terms of your stock. Whereas with a partnership, you can be liable for all of your other personal assets that aren't protected by law and potentially lose everything if one partner does something that you don't want them to do. So, assume that you and I are business partners on a deal and you do some horrible, terrible, or I do some horrible, terrible, legal things in terms of embezzling and, getting involved in bribing local officials to get a project built and all of this other sort of stuff. Well, whatever bad things that I may do, ultimately, if you're my business partner on that, in that deal, you would be held personally liable for many of those things that I did as part of that entity. Whereas with the corporate entity, not so much. Okay? There you've got, in essence, protection by law for that particular sort of entity being the corporation. Now, I'm not getting into all the little nuances that, hopefully you're going to probably get into in the law course, but let's just kind of move on down the street here. So that leads us to S-corps, small business corporations, or subchapter S corporations in the Internal Revenue Code. And S-corps, much like partnerships, let's say that you've got $100,000, all right, and that, and you've got basically, you're generating $100,000 of taxable income. You've got two partners, A and B, same sort of scenario from above. So in essence, you're going to probably have the same tax liability as the partnership, but the ownership protections that you have are in essence the same as the traditional C Corp. So now you've got to ask the question, hold on, well, if it's the best of both worlds, why isn't everybody set up, all corporations set up as C Corps, or set up as S Corps? If they give you the tax advantages of the partnership, and they also give you the protections of the traditional corporation, why can't you just have everybody set up as an S Corp? Once again, keep in mind, all of these are legal distinctions, okay, in terms of the partnership ownership, or not partnership ownership, the ownership form of the real estate. Well, the reason is because by law, you are limited to the number of shareholders you can have in an S Corp. And if my memory serves me correctly, it's about like 40-something, 45 maybe shareholders maximum that you can have in an S Corp, whereas with a C Corp, you can have 1 million investors, okay? But with an S Corp, you're limited to around 40 or 45. It's going to be a small business corporation, okay? So that's why, all the other corporations aren't necessarily S Corps, because they have too many shareholders to allow them to be S Corps. And then you've got other variations of this that you probably have heard of. You've heard of limited liability companies, limited liability partnerships, and all of which sing and dance around these same kinds of issues of protections from legal liability and lower taxation. But the one that we're specifically wanting to address our attention to are real estate investment trusts. Real estate investment trusts are not a new thing, okay? These were created back around 1960, okay, just to kind of put things into context here. And they were created pretty much for the sole purpose of owning, operating, and managing real estate. Just kind of write those words down. Owning, operating, managing real estate. Now, what word is conveniently left out of there? Development. Is not really an option for a REIT. Okay? REITs, for the most part, are holding companies. Okay? Meaning that once you have the real estate built, developed, constructed, all of that sort of stuff, in other words, it's open for business, then you form a REIT, put the asset into a REIT. You are not, to kind of go along with development, trading, selling real estate is also very limited.
Because you're supposed to hold on to it when you have everything in the trust, right?
Yes. Okay. So the idea is that pretty much whenever you put something into a REIT or you acquire property into a REIT, it's pretty much a buy and hold strategy. Okay. That if you're constantly trading and selling assets from that real estate investment trust, eventually, at their discretion, the IRS will say, hold on a second, you are not truly a REIT, because a REIT is only supposed to really be about owning, operating, managing real estate, not involved in trading and selling. Now, does that mean that you're stuck with every single property that you ever bought in a REIT? No. But what it means is you are probably limited in some way as to what percentage or what dollar amount of your portfolio that you may be able to sell off in any given year, okay? So let's put things into perspective. If you're probably selling off 5% of your portfolio each year, the IRS is probably not going to be overly concerned, okay? But if you're selling off 10, 15, 20, 30% of your portfolio almost on a regular rotation year after year, the IRS is going to say, hold on a second, you're not really, truly owning, operating, and managing real estate. You are, once again, engaged more in trading and selling. Okay, does that make sense? Okay. Now, are there absolute, hard, fast, rules as to the exact percentages that you can sell off in any given year and that sort of thing? Not really. It's kind of at the discretion, to a certain extent, of the IRS. Okay. Now, you can probably get into all sorts of cases that have been tried, and you can kind of maybe get a sense for what it might be that would trigger the IRS to kind of engage in this. But here's the big nasty of this is that if at some point in the future the IRS says that in essence, yeah, you haven't been operating as owning, operating, and managing the real estate, that you've been more involved in trading and selling, they can come back to you for the previous year's taxes that you haven't paid and penalties associated with that. So this is a very important thing. And you say, well, why would they do that to you? Once again, the rules have been set up in a way for the person who understands the rules and abides by the rules to benefit. The person who is ignorant of the rules and who doesn't follow the rules doesn't benefit and gets hurt, okay, or taxed. It's as simple as that. And if you think about it, most of our society, that's how most things operate, you know, in the sense of legal versus maybe not so legal. And now, what is the benefit of putting everything into a real estate investment trust? Basically, it gets taxed as a partnership, meaning the entity itself, the real estate investment trust, doesn't necessarily get taxed at the REIT level, as long as, back down here about the REITs, they must pay out 90% plus of all basically taxable income each year. So what that means is if they earn $100,000 of taxable income, like the previous scenarios, 90% or $90,000 plus must be paid out in the form of dividends to the shareholders.
And then it gets taxed again?
No, it doesn't get taxed at the REIT level, that's my
So
point.
it's just paying out as a
As
dividend?
long they're forced to pay out the 90% of all the taxable each year in dividends to the shareholders.
That's how all trusts work.
Okay? So that means they can keep up to 10% internally to basically expand or work with
Claim it.
in some way. Okay? Now, a couple of other rules associated with the real estate investment trust. Once again, every one of these has all these little nitpicky, specific rules that allow it to qualify or be disqualified. For REIT, once again, you can take a look at the textbook that's been updated about this, but basically you need 100 shareholders or more. And within that ownership structure, no more, or let me phrase it a little bit different way. Okay. 50% of equity ownership of the REIT cannot be held by 5 or fewer people. Okay?
So it's either or?
No,
Or both, you're saying?
both holds.
No. In
It's
other words,
100 shareholders plus 5 or more can't be 50%?
in other words, you're going to have more than 5, okay, if they're going to own more than 50%, okay? Now, so the idea is there you can't have super concentrated ownership, okay? In other words, because a lot of real estate, you may want to have a situation of where you're sort of saying, okay, as the master developer of this, myself and, my 3 other business partners here, that's 4 of us, and we each want, let's say, 20% each. Well, 20, 40, 60, that's 80%. That's not going to be allowed. Okay? Now, if I gave each of us 10%, then 10, 20, 30, 40, that would qualify. Okay? If we have one more partner that potentially had up to 10%. Does that make sense? Okay, but the point being is we've got to have, keep in mind, we've got to have 100 shareholders. Okay, so that's where, that once again, you think of it like this.
How do you do that?
What do you mean?
You say you're saying you need 100 people.
You've got to have 100 people for a real estate investment trust. Other trusts are different.
No, but
A real estate investment trust, you've got to have 100 people by law. So my point with this is, with each of these ownership entities, each one has different rules, each one has different, basically, results as it relates to tax implications, and they have different, each one has different restrictions as to what you can and can't do, okay? My point with that, this is where obviously the lawyers come in, you know, super, you know, relevant, super important, because it may very well be that for one deal that you do may be structured with one type of ownership structure. Another deal, totally different ownership structure. In other words, one size doesn't fit all. In other words, there's no one perfect ownership structure because the circumstances are going to be different. You know, if you've got 100,000 shareholders, you're limited into which one you can do. If you've got 5 shareholders, you're also limited into which one you can do. If you have a situation of where you want all the legal protections afforded to you in the ownership structure, you're limited into what you can, you know, so you sort of see my point. It's almost like this big matrix, you know, of here is, you know, my project, here are the boxes sort of ticked on that project, here's the ownership structure that makes the most sense for me. And that's in essence what you would go through with your real estate attorney, okay, to actually sort of figure this out and what makes the most sense for you, and you know, what is it you're trying to do? Are you trying to minimize your tax liability? Are you trying to maximize your protection, you know, from others suing you? What is it you're trying to accomplish? Okay, does all that make sense conceptually? Okay, once again, you can get into the devilish details with David Weissman and with Jorge San Miguel next semester and all the little nitpicky nuances of this, but the point is, this is, you know, sort of important for you to begin to think about. Now, why it's important in this class is because of the impact on income tax, which then relates to what sort of a rate of return that we get as an owner or operator of the real estate. Does that make sense? Okay, so I'm kind of giving you the broad strokes of saying, yeah, this ownership structure is going to cost you more money, this one's not. Okay, all right, moving forward. Any questions?
Could you avoid, like, you were showing S corporation seems to be a good deal and the maximum for shareholders, and then you were like talking very softly, LLC and LLP, with broad strokes.
I'm saying that LLCs, limited liability companies, and limited liability partnerships are just other forms of ownership that have similar taxation structures to partnerships. But they're just simply a different entity form in how they're classified by law. Okay?
Is there like people that help you get like 100 shareholders? Like what if you just like don't have the
Well, yeah,
ability to
if you're
set
gonna,
that up?
and once again, this is not what I
do. Right.
But yes, there are
So
syndicators.
how would you do?
No, there are people that specialize in, I mean, look, as a practical matter, let's just cut it all to the chase. As a practical matter, if you're trying to raise money for a real estate project, yeah, it may come from the whole, you know, the FFF, you know, friends, family, and fools, okay? And
That's so funny.
but beyond that, you know, in finding participants in or for a particular real estate deal, what I have seen happen in a lot of cases, you know, beyond just the people that have their own little sort of connections into the community, is that as a practical matter, one of the central points are CPAs. Because if you think about it, CPAs see everybody's tax return.
Correct.
And so the CPAs are going to know about their clients and about their clients' potential interest in, or
We already like know the
yeah,
basis.
they're going to potentially know, you know, who within their client base would be potentially interested in investing. And so what I have seen, you know, is in a number of cases that CPAs would sort of, you know, you as an investor or as a developer, you might take literally a handful of CPAs, you know, here's a portfolio of projects, and then they would, at their discretion, pass it on to their clients if they felt it was, you know, something worth passing on. But they're usually kind of a good little sort of go-between. Now, outside of that, I mean, I'm talking, that's more of, you know, still kind of a very personal, almost neighborhood level kind of thing. You know, to get much broader in context, you know, then you're starting to talk about, you know, professional syndicators and people that are, you know, putting together joint ventures, and then and in some cases taking, you know, it public and actually setting up an initial public offering for a corporation. You know, that's a whole different thing. We'll talk a little bit about that, but that, you know, a much grander sort of scale. But see, this also gets in that for certain types of investments, you are also limited with respect to, technically by law, qualified investors, which have to have, you know, a base net worth of several $100,000.
That's what I'm saying. I just don't think that's the easiest thing to form.
No, I'm not saying it is. I'm just saying, but there are all these different, you know, issues that you've got to sort of consider. But it's if you want to sell shares into a real estate project that you're doing, it's not just as easy as saying, okay, I want to sell you, you know, $100,000 of shares in that real estate venture, unless they are really partnered with you in that. You know, in other words, if you want to keep, you know, sort of a distance of more of, you're the general partner, they're the limited partner, and that sort of thing. In many cases, you know, there's going to have to be this whole thing of, are they a, by law, qualified investor, which means they must have several $100,000 of net worth just to be legally qualified. Now, I'm not saying that people don't have people invest in their projects without going through that process, but technically, part of the protection for people who are not qualified investors is if they do invest in something and they were not deemed to be qualified investors, there's a very good chance they can get their money back. Okay? And even if the project potentially loses. So there's some, you know, real significant issues there that you've got to, I mean, everybody's happy as long as they're making money.
Right.
It's whenever they stop making money or they start losing money that people get very unhappy, and then all of a sudden, once again, the lawsuits come out and then say, well, I'm not a qualified investor. I don't know what I'm really doing. Therefore, that $200,000 I put into this, you know, I should get it back because I didn't realize it was, you know, what I was really getting myself into. So that's a whole other angle to this. Okay. Did that answer your question?
Yes.
Okay. Now, so this little problem that we're going to kind of go through is kind of makes the assumption that as we're talking about this idea of kind of having or managing sort of portfolios of real estate on a very basic level, kind of how you would maybe go about this. It's glorified sort of property management, okay? But you know, whenever you start talking about these $100 million, you know, or more portfolio sort of deals, you know, it gets a little bit more, you know, they may change the wording up a little bit and that sort of thing, but at the end of the day, we're really talking about, you know, property management and portfolio management. Okay, so let's just say that, and this is an annual stream of income, and you're getting, I don't know, let's say $20 million a year as the overall portfolio. Now, you, as a management firm, are going to manage this portfolio for someone else, and that management fee is really going to be dictated by your level of involvement in the sort of day-to-day operations and oversight of the property. So, you know, it could be where the management fee is maybe 1% or even less than 1%. Could also be where it might be 3 or 4 or 5%, all right? So let's just say, in this case, the management fee is going to be 3%. Then we have something that we refer to as the valuation multiple, which is basically just the inverse of ERV, okay? And we're going to talk about here in a second. And what this is, for those of you that have studied finance, traditional corporate finance at all, one of the things when they talk about company valuations, you know, they will typically talk about sort of, you know, earnings per share. They'll talk about, you know, things, you know, related to multiples of the share price or multiples of the earnings. A company is, you know, or multiple of earnings in terms of how the company is valued. Well, with real estate, it's somewhat similar in the sense that if we've got earnings or revenue of $20 million and we apply a valuation multiple, let's say of 8.5, this is just the opposite of ERV. So here, what we're saying is that earnings are not necessarily, you know, we're not using it as a cap rate, we're using it as a multiple, and you're going to see what I mean here in just a second. So what that means, this is kind of, I'm just going to carve out some space here to actually, so if we've got the overall value, we've got the income or the revenue, and then here we've got the multiple, or also can be called a factor. All right? So in this case, if we know the revenue, so this is just the opposite, as I was saying, just the inverse of ERV. So ordinarily you put income, you know, up on the top. Here we're putting revenue here on the side, 20 million, okay? And our valuation multiple is 8.5. So what you're going to do is you're going to take 22 million times 8.5, and that is going to give us a valuation of the entire portfolio of 187 million as the portfolio value. Okay? Does that make sense? Okay, so like I said, it's just the opposite. So what we're saying, in very, very simple terms, is that the valuation of the portfolio is 8.5 times the revenue that it generates. Okay? So if it's generating $20 million of annual revenue and the valuation is 8.5 times that revenue, you're taking 20 million times 8.5 gives you 187 million. Okay? Now.
Okay. Professor.
Yep.
I get
Yes, so do I.
170 million.
Me too.
Well, I put it in wrong.
Yeah, you put 22 million in instead of 20.
I keep thinking I'm doing all my math.
Okay, well, let me put it in again. 20 million times 8.5, 170 million. Okay. I bet. I put it in wrong.
You put 22
Okay,
million.
all right, so 170 million. All right, 170 million is the value of the portfolio. Now, what that means, and this is a way to sort of think about this, and the reason that finance people like to use this sometimes instead of cap rate, because it's also kind of a way to sort of say that factor or that multiplier or that multiple, whatever you want to sort of call it, another way to sort of look at it is based upon that revenue, it would basically take you 8.5 years to basically generate as much revenue as what the value is, okay? Now, this multiple, think of it like this. A multiple is just simply saying that if you've got a really super duper simple business that almost anyone can figure out and do, doesn't require a lot of startup, doesn't require a lot of investigatory work, doesn't require a lot of due diligence, doesn't require a lot of just anything, that multiple is usually going to be really low. Like for example, I'm trying to think of one of the simplest businesses that you could probably start, like a lawn care business, okay? You start a lawn care business in the sense of, and when I say simple lawn care business, I'm talking about you've got a couple of people out there pushing mowers and weed eating and that sort of thing, and you go to sell that business to someone else, and they're going to say, well, what's the value of this business? And that's a pretty simple business. What are you really selling them? You're really selling them your client list, okay, and not much more, okay? And so the value of the business is really going to be how much time is it going to take them to acquire the clients that you have acquired over the past however many years you've operated this business, and more than likely that business will only sell at 1 or 2 times, no, it's maybe probably even 2 times that multiple, meaning that if you've got $100,000 worth of clients, the business might sell for $200,000. Does that make sense? Because it's pretty simple. But if you've got a much more complex business that has, in addition to just, you're buying contracts, you're also buying equipment, you're buying buildings, you're buying personnel, and so forth, so on, that multiple gets higher and higher. Now, here's the thing. The more complicated, the more unique, the more, what's the word I'm looking for, the more difficult it is to replicate an existing business, the higher that multiple will be. Okay, now, anyone who has paid any attention to the stock market, and specifically any particular companies within the stock market, what one company above pretty much all others have people said fairly consistently is probably overvalued because it has such a high multiple? One answer. And don't say Apple. Don't say Amazon.
Yes, Tesla.
You took my guess.
Tesla?
Because it's not Tesla. Okay? And the reason is because, a lot of people really fundamentally believe, in Elon Musk, okay, but putting all that aside, it's an extremely complicated business, extremely complicated technology, extremely, complicated to replicate that in any form.
Everyone's
okay?
trying.
And so the point is, the multiple on a company like that is going to be really high. And I don't even know. If somebody wants to Google it, and you can figure out, and you say, earnings multiple for Tesla is probably going to come out something ridiculously high compared to virtually any other company out there, okay? Now, having said all of that, what we are searching for here is what is,
79?
okay? That
79?
sounds probably right, but it's a ridiculous number, okay? Whenever you compare it to many other companies out there.
Everybody else is at 25.96 and they're at 79.
Right.
All the other automotive domestic
Yes.
industry companies.
Okay, so I am correct.
No, yeah.
Okay, now,
Very, very correct.
okay, so we come back over here, and what we're going to ask you to solve is, well, what is the value of this management fee stream? So in other words, if we are awarded the rights to manage this portfolio of real estate, how much are we going to get? Okay, well, our management fee is dependent on the size of the portfolio. Okay, so from what we have just done, the management fee stream is going to be based on taking that 170 million, multiplying it by our 3% management fee, or 5.1 million would be the management fee stream value, which is what you're solving for. Okay? Are we good?
Yes, sir.
All right. We got
So
about 10 more
the answer
minutes.
is 5,100,000?
Yep. Correct. Okay. Moving forward. We got about 10 minutes before they join us, so let me.
Was 4, when we did 4, we were just looking for the rate of return, right? I'm sorry, I'm just going back for 1 second. That was all we saw for.
Yep.
Okay, thank you.
Okay. So question then 7 is about REITs and specific.
6.
No, we just went through 6. That was 6. Okay. This was 6. Okay.
So it was 5.
Yeah.
What was 5? Because we did rate of return, which was,
5 was comparing the two portfolios.
oh, comparison, okay, thank
No,
you.
that's what it was for.
Okay. Question 7 deals with the rules about basically REITs. So it's actually a short little answer question.
I
So
like that,
REIT rules.
my favorite.
Okay, question 8, also REIT rules. Okay. All right. Question 9. All right. Let's talk real briefly about initial public offerings, also known as IPOs, for real estate. So, IPOs are not something that you're going to deal with in the traditional sense with a small project, okay? This is when you're talking about large-scale, development. And when I say large-scale, probably $100 million plus, okay? And for this type of real estate venture, you're creating maybe a single-purpose entity and doing initial public offering. And the thing to sort of walk away with here, a couple of things. One is it's going to probably cost you at least 6-7% for an investment bank to do that IPO. So, simple way of looking at this, if you've got $100 million that you're trying to basically raise in funds, you're going to pay, let's say, 6% of that, or let's say $6 million to an investment bank for their assistance in getting those shares of stock sold for you. But that's probably not the end of the story. There's probably other legal fees, other transaction fees, and so forth, so on. My point being is, this is why it's expensive to do an initial public offering, is because there are all these extra sort of costs associated with it, but it can potentially get you big sums of money from, larger scale projects. But what we're going to concern ourselves with is, let's say that we are going to sell, as part of our initial public offering, 50% of our equity. And let's say that 10% are the actual IPO cost. Keep the numbers simple. So the question is simply then what percent are we giving up in terms of our equity? In terms of the cost, okay? So all you're really doing there is you're multiplying 50 times 10, and you end up are giving away like 5% of your equity just by doing the initial public offering, okay?
How did you do that?
Okay, if we're selling 50% and our IPO cost for 10%, 50 times 10 basically gives us 5%, okay? And if you want additional clarification, once again, in the textbook, chapter 21, specifically, it would be on page 305, if you want additional explanation. All right, now, the last question, we're running out of time here, is a very simple question. What is the difference between return of capital versus return on capital? Once again, this is fully described in your book, and I'll give you a quick little overview here. In your mind, what is return of capital?
Giving the investors their money back.
All of it comes back.
Okay, exactly. Investors getting their money back, the original money they invested. So return of capital is mean you're reclaiming the money that you have put into a project and you're getting it back. Return on capital
Percent you're earning.
is basically in any given year, you know, sort of what is that rate of return that you are generating on that capital that you have invested. Does that make sense? Mm-hmm. Okay? But if you invested $100,000 and you are generating $10,000 a year of income, you could say, yeah, I'm getting $10,000 a year. If you want to just sort of look at it like that, I'm getting $10,000 a year as a sort of a return of my capital each and every year. It's going to take me 10 years to get my money back, if we want to just simplify it. But if we want to look at it as we're keeping that money invested in the project, and at the end we're going to maybe sell the project and that sort of thing, and while we have that money invested, each year we're really getting like a 10% rate of return or return on capital of 10% each year, and then ultimately when we sell it, then we get our return of capital in the form of a reversion. And that's it. Okay, so at this point, I'm going to stop sharing my screen, and it looks like Stephen has joined us. All right. He's connecting to the audio.
The chapters were which ones again?
20 and 21.
20 and 21.
Hopefully you can connect here pretty easily. Oops.
When's that building gonna be done, the last one?
We already TCO'd the lawyers are gonna
Yep, For some reason, it looks like he's having some difficulty getting connected to the
It's
audio.
really in there.
Acronym lawyers?
The whole building?
No, it's 2 floors. You know, we're gonna fight some lawyers.
Lease.
We're
Who's
gonna,
gonna lease the rest? Norm?
we're moving the building.
Styles are moving into the whole office?
Yeah, the car, 2
So
floors.
who's moving into
Go
Styles?
quickly
Somebody said no.
to take a break with us.
Damn, I didn't know that. That's so sad,
Yeah.
depressing.
Is it
Okay, it looks like
My
Steven's having a little bit of difficulty getting connected to the audio. So let's take like a 2-minute, for the people here in the room, 2-minute bathroom break. And then the rest of you, if you need to take a quick little break, hopefully Steven and Noel will get connected here in just a minute.
That's, I didn't know you guys were moving. That's
Yeah,
exciting.
I think we're on the 11th and 12th floor.
A lot went down in that office. I miss it. I couldn't imagine actually going to the office every day.
Okay, so while Steven is getting connected to the audio, I sent you a couple of different announcements this morning. The first one just describes, obviously, that Steven and Noah are going to be joining us today for discussion, a Q&A session about their project, the Palmer project. The first one I sent you, the link for the pictures didn't work, it's expired. But the second announcement I sent you later this morning, if you click on that link, it should take you to like a WeTransfer sort of thing where you can pull up all the different photos for the project and be able to see those. So go ahead and if you don't mind, if you haven't already, pull those up so you can take a look at them. And then hopefully once they get connected, then we can have them walk us through the project and give us the opportunity to ask some questions. Stephen?
And Dr. Ford,
Yep.
in the mentorship mentee program, so I'm already starting. I've been having my meetings. Should we don't send those forms, the evaluations to you, do
No,
we?
those are
Okay.
strictly between you and the mentor.
Okay, I just want to be sure.
Yep.
So far, it's going on great too.
Excellent, excellent. Okay, Stephen, are you fully connected now?
Professor?
Okay.
Good morning, Dr. Morgan.
Morning, morning. Okay.
Morning, everybody.
Good morning.
So here is the plan. Let me see if I can blow up. There we go. Okay. So Stephen, I obviously asked you and potentially, I guess, is Noah going to be able to join us as well or not?
Yeah, he should be on here if he's not already.
Okay. So the plan is that I sent all of you, and we talked a little about in class previously. Stephen Gouache and Noah Leon are both graduates of the MSRED program from about 3 or so years ago. And then once they graduated, they formed a company, Defined Companies, together. And what I would like for them to do is to maybe start out and talk about some of what they did with respect to just getting started and kind of what their backgrounds were prior to coming into the program, but also what they did in terms of, I know that they invested a lot of time and effort in the ownership structure and kind of the setting up of the company and making sure that they were both happy and satisfied with how it was set up and structured. And then to talk about the Palmer project and anything else they want to talk about. But specifically, as they talk about the Palmer project, they can talk about all the physical things, they can talk about all the regulatory things they went through, and to the extent that they can and want to get into some of the financial details of just simply how the project was structured in terms of debt and equity and investors versus partners and developers, that sort of thing. Certainly welcome to jump into all of that as well. But just to sort of start off, welcome to Stephen. I'm assuming Noah is there, going to be joining us soon. So Stephen, you want to just sort of launch off, I guess, into kind of your background and then kind of how you guys got started?
Absolutely. Thank you, Dr. Forty, for that. Good morning, everybody. As Dr. Forty mentioned, my name is Stephen Gouache. I was a former student in the program, now an alumni, of course. I graduated back in 2016, and 2017, we officially launched Defined Companies. So, over the course of a year and a half, call it, more so a year, Noah and I talked about, getting into business together, and, we formulated our business strategies and, put our plan together to raise the capital to get our company going. So, it took a good amount of effort. I was working full-time. My previous background was in finance. I worked for a developer. That's how I got my foot in the door as an analyst. So prior to going into the program, I was already working for a developer, and I actually fell in love with what I was doing. So I decided to pursue, further education just to expand my knowledge and skill set here. So, I attended the MSRED program, and, hopefully you guys are getting a tremendous benefit from it as well, but I was able to connect all the dots because real estate development is a fast-paced type of environment. And, so it's a sink or swim, definitely, and you don't have the time to really understand what it is or why it is you're doing things. You have tabs and you do them. You're working for, one of the large-scale developers, and, not necessarily knowing why you're doing it. So in the program, I had the opportunity to kind of ask all the questions, connect all the dots, which really accelerated my learning and, understanding of the whole development process. So, having that fundamental skill set just coming into the program and then being able to ask the questions really was a tremendous value. And of course, the networking perspective is huge in this MSRED program. And, I kind of heard the mentorship program being discussed here earlier, and I hope you guys are taking advantage of that as well. These mentors are all about helping out. We're a family here, so if you need anything, all it is a phone call, and they'll put you in contact with the right person. So don't hesitate. I know sometimes it could be a little intimidating talking to your mentor or whoever it may be, but just put that aside. That's what we're here for. So going back to how the company got started, during the program I met Noah. I took the program very seriously. So did Noah. We saw that in each other. And during the program, we talked about potentially doing some business together. And after I graduated again, over the course of a year, we took a lot of time and effort formulating business strategies, business plans with how we're going to get this company started and what exactly it is that we're going to be pursuing in our first couple of deals. So, of course, we laid that all out in the financial forecast, what our overhead would be as far as funding salaries and such, because the reality is, we can't just, hit this full time and not be able to, pay the bills and, feed ourselves. So, all that was incorporated into our financial forecast. So, we laid it all out. We structured our corporate entities. We worked through our operating agreements, with different attorneys, and Noah and I are all about transparency. I'm not sure if he's on here yet. He should be, but if let him chime in a little bit as well. But, we're all about transparency. Noah and I sat in the same room with the same attorney talking about all the terms, about the, in the operating agreement as far as, if I die, he dies, a lot of things that people don't like discussing. That's what business is. It has to be transparent. And if you can't be transparent with your partner, then what's the purpose of even partnering with them, right? So that's what we did, and it worked out beautifully because Noah and I started that foundation, and we've been operating under that premise ever since. Nothing but transparency. We carry ourselves that way with everyone we work with, and they appreciate it. Some that don't appreciate it, they're actually not working with us anymore in the future, so that's the reason why. So there's a reason for it, of course. So it took a lot of time and effort getting to where we're at. We officially launched the company in August of 2017. So again, it was about a good solid year that we formulated our business plans and put our ideas together. Again, I was working for a full-time developer, the Altman companies out of Boca Raton, Florida. I left them July of 2017 and gave them a 2-month notice. I started there as an analyst, as I mentioned to you guys. Started the program as a development associate, and during the program learned a lot and was promoted to development manager before I left the company. As an analyst in development companies, I was responsible for all the initial underwriting, all the feasibility studies that you guys are learning here in the program. I had to get thrown a vacant piece of land. I had to do all the research on the markets, all on the the competition, and understanding exactly what it is that the market can actually support on that piece of land. And of course, working with the entire team at development company, I had no knowledge on construction. That was probably my weakest suit. And of course, they had all the resources to provide me with all the information as it related to all the different aspects of the development process. So I'd be responsible for, putting together the performance, looking at the markets again and putting together feasibility studies. The projects you guys are tasked to do here, these investment packages or call it capstone projects, this is what happens in the real life for investment committees. For the Altman companies, I was responsible for putting together the investment committee package, which sometimes entails a package of over 100 pages. So again, all the information wasn't necessarily put together by me, but I had to put it all together. So I had to get the bids and the estimates from the contractor on what our product type's going to be. Of course, even getting to that point, I had to understand what it is we were proposing. So of course, the powers that be would feed me that information. I would just apply it to the others and get, compile the information. And I had to have one cohesive package of what this investment would entail. And we would sit down together in a room with all the executives and review this financial or this investment committee packages, which included all the data again. Down from the site itself as to how big it is, all the constraints it had, to the market constraints, how much rent can we get, how far can we push it, what are the comps actually doing, and then showing our product type and how that all flowed into a financial pro forma. So, you guys are doing that. And, right now it's a classroom setting, of course, to take advantage of asking those questions and get yourself put through the ringer, because in the real world, that's exactly what you're going to be doing. You're going to be held a lot more accountable for this. And for every number you put into that investment committee package or every financial feasibility, you have to have justification back and forth. You can't just say, oh, I pulled it out of the air, or this is what I'm thinking. No, that's not how it works, guys. You need some type of understanding and real justification for these figures and information. So, what you guys are doing there is exactly what happens in the real world. Just, take it very seriously, because it's going to help you definitely get your foot in the door, if you're not already, into a real estate development company, if that's where you guys want to ultimately be your goal. So, with that said, I took all my understanding of the Altman companies from that financial underwriting, which has helped me today in my company. I quickly got involved in more of the project management. Again, being a fast-paced company, I was just telling them to throw everything at me. Send it my way. I wanted to get involved. I loved what I was doing, so I really wanted to learn what I was doing, and I threw myself in the middle. When things weren't getting done, it was a tough time when the market was picking back up, the economy's growing. There was a lot of turnover at the company as well, because people were just moving from job to job because they're getting different offers. The market was hot, so people were paying more, and there was a revolving door at the time. So I took the opportunity and just jumped in where the gaps were created when people left, and just doing their real role and responsibility. So what I tell you guys is, I'm serious when I say it. I was working there and I was doing the role of 3 different people, and I wasn't getting paid for it, right? That was one of my biggest complaints, but it is what it is. I can't complain today, because everything I learned put me in the position to be where I'm at today. So, that was the reality. I was doing the job of vice president, of a construction manager, and of course myself as an analyst and associate, so actually more than 3 titles. So, I learned a lot, and it was it was a grind. It was a lot of long nights, early mornings for the company. And again, it wasn't my company, but I was dedicating myself. I was easily working 50, 60 hours a week there at the Altman companies, plus doing this program full time. Again, probably the most stressful year of my life doing this program. So I understand your guys' pain, trust me, especially working full time, with that. So, but it helped, really helped me understand the entire process. And, getting involved in that nature really allowed me to manage a project, get ahead of the city, work with architects, engineers, and really understand the process as a whole. And once the way the Altman company is structured, their, tier of tenure, call it, of the corporate ladder, starting as an analyst, going to associate, manager, vice president, really that helps you, really formulates you to become a real strong developer. Because if you can understand the financial portion of what exactly a project entails, then you start learning how to manage a project where you're doing the different things and you're planning and you're talking to cities, municipalities, you get comments and different changes to the plan. You now understand how those underlying changes affect your pro forma and what your feasibility is going to be in the future. So, all these things go hand in hand. So let's be able to have that base understanding, kind of move up in the ranks, in the ladder per se, and, be able to excel in those aspects because I already had that underlying experience. During my time there as well, I met a lot of turnover, a lot of individuals, employees who started the company who only knew certain things. They would know construction, but they wouldn't know finance, they wouldn't know the actual entitlement process or development process itself. You'd have guys who were fully versed in finance and didn't know anything about development. So I was able to kind of touch on all the different aspects, which really helped me, become who I am today. And, you know, at the end of the day, that's what a developer is, right? They're quarterback. You have to have an understanding of what every piece of the process is. You don't have to be a master at all. You know, it's good to understand them all, you know, especially the financial portion, because at the end of the day, that's who you are. You're a business owner, you're a developer, so you know, finances are important. But all the other aspects, you know, you could always find those folks who can fit into the equation to really run those pieces to ground that you're not as versed in. So as a quarterback, you just have to be able to be familiar with the entire process, and that really helps. So, you know, again, we're going through the program. I was able to get promoted again to development manager before I left the company. And at the time, you know, I was running 5 different projects, you know, throughout here to South Florida, Central Florida, and also Texas. So, you know, I was responsible for, you know, over $350 million of capital investment during my 4-year tenure at the Altman company. So a lot of responsibility, but again, I'm very grateful for those guys for everything they taught me. You know, I was not hesitant to ask questions, and guys, please don't be, because that's the only way you're going to learn. If you're sitting in the back room and just being quiet to yourself, you're never going to understand these things because you're not asking questions. There's a lot that goes into development, and I'm still learning. And I don't think I'm ever going to stop learning until I die. And that's the reality of it. So if anybody tells you that they're an expert in development, they've learned everything, they're lying to you. That's not the case. You know, there's a lot to learn. You can ask any of your mentors as well who have plenty more experience than I do, and they'll tell you the same thing. They're still learning as well. For example, this pandemic. You know, this is something new to everybody. You can't plan for this stuff. So this is, of course, a great experience for me to go through. Luckily, we're still surviving through it, but I'm sure anyone you talk to, including your mentors, asking the same question. This is new to everybody. How do you adapt? How do you change? How do you keep pushing through all these different changes? So, you know, luckily, things are still moving at a steady beat here for the most part. We'll see what happens over the next year or so. But, you know, these things are challenges that face you every single day. So don't think that, you know, that you're going to pick everything up and learn it as soon as you leave this program. No. There's plenty more to learn, and again, don't be hesitant to ask questions. So fast forwarding a little bit again, you know, August 2017 is when we actually launched the company. So it's been, you know, we're on our 4th year here. It's been over 3 years. You know, when we first started the company, we both started with nothing on our plate here. We had zero leads. We had zero, you know, projects we're looking at. We're all about, you know, we're working on somebody else's dime. That's exactly what we're going to do until the last day. And that's what I did at Altman companies. It's not like I was part-time there and doing side deals on the side. Now, when we left and we started off to define companies, we had zero. We hit the ground running, but at least we had the foundation set. As I mentioned, we had all our operating agreements ready. We had our business plan ready. I had my financial performer ready. So we worked through all the mechanics and all the templates and everything to prepare ourselves for day one, and that's what we did. So day one, you know, and I'm not sure if Noah's on here yet. If you can, I'd like him to chime in a little bit on his background. If not, I can. Noah, are you there?
I'm here. I was letting you go there.
Perfect. So, you know, again, I'm Yang and he's Yang, and that's how we operate. You know, I do certain portions of the project and the process, and so does Noah. So now that we started the company, you know, Noah is the upfront, you know, relationship deal maker. You know, that was his experience. And I'll let him chime in and elaborate on how, you know, his background and how he was able to facilitate our first couple of deals here. So go ahead, Noah.
Sure. Hey, so I'm Noah. Stephen and I originally started formulating this company probably about a year in advance, kind of going through the different roles. We did sit down where we act very transparently, and I will get into the kind of deal-making thing in a second. But we do act very transparently. A lot of people don't like it. I'd say that we operated, and I'm not patting ourselves on the back here, but we operate at slightly a different level than some of the people that we are currently in business with. And as Stephen was saying, we're kind of progressing on. The larger groups that operate similarly, they have taken notice. They actually reach out, even institutional sized deals where they say, hey, you know, you have a good deal, bring it to us. And we're not talking about, you know, small projects. We're talking, you know, 300 deals. So my background, I can touch on. I came from the brokerage side. Actually started just as a, and I don't mean to insult anyone here, but as a simple residential real estate agent. Then I got involved in distressed assets. I got involved with high net worth individuals. I got involved with a REIT that was picking up everything possible for single family homes. I got into value add multifamily with some of the high net worth individuals that really wanted to, I guess, expand their portfolio at the time. You know, it was the right time. This was 2012. Then we got into kind of, I say I was on the operational side. It's not really true now that we actually own real estate and we're operating it ourselves. But I got into dealing with tenants, essentially creating tranches and credit properties, creating portfolios and selling off portfolios simply as cash flowing assets, asset repositioning. A lot of the, as Steven says, I'm kind of the relationship, the upfront person. So a lot of the, I guess, relationships that we have and the opportunities we have had, especially at these larger projects, have come from previous relationships, to the point that, we've had a few runs at some really, really good deals. Unfortunately, we lost out on some of them, or actually we lost on all of them. So I don't know if most of you are from South Florida, but we lost our first big run. We actually had the best plan. We were dealing directly with the REIT, and Related Group ended up beating us out on that. We did have an institutional partner who recognized the way that we operate, and they loved it, and we're still pursuing deals with them. But to kind of get back to our core, we are practicing the crawl, walk, run scenario. So right now, we kind of, our first deal, and I don't know if Steven elaborated on this, I did join slightly late here. We worked out of the back office at my home, and he was driving to my house. You didn't get into that? So we worked out of the back office at my home, and he was driving to my house one day, and he said, hey, there's this apartment complex right next to Funky Buddha. We should buy it. So I put on my my stalker shades, I guess, and started calling, and eventually got to the right person, digging around. We started talking numbers, and she kind of said, look, a lot of people want to buy this. I'm not selling it. We came up with something that made sense. We took it down. I believe that was December 21st of 2017. The average rents there were about $810 a month, and I joked that we were slumlords. And this is why I said I thought we knew operations. We didn't. We never expected some of the things to happen. It happened. However, we applied for permits, and we were still cash flowing the property. Actually, I believe we were slightly under what we needed to be. However, we knew that as we did the work, we would have a significant delta over. So, is that right, Stephen? We operated in the negative by a very small portion, correct?
Yeah, that's correct. When we underwrote this deal, we knew that we were going to be in deficit, but we actually picked that up in our underwriting as far as our budget just to cover our working capital deficit. We signed up for this project, more from a marketing standpoint. Of course, everything has to be financially feasible, but we were willing to take a little less just to prove our skill set and show exactly what it was we were doing. So on the acquisition itself, we were so our cap rate was a little higher going in than it was lower going in than it was that our investor was that we're paying for our capital. So we were running at a deficit from that standpoint. So we weren't able to meet our interest obligations on the property, but again, in our total development budget, we budgeted for those deficits, so we were able to pay the interest throughout the project. And of course, when we underwrote the deal, and I'll let Noah get back into it, when we underwrote it, we knew at the renovation standpoint, we would have the upside, and that's where we would increase the cap dramatically in the rents and everything else. I'll let Noah get back into that. So we did pick up the property, understanding that we were going to operate in a deficit, but again, we budgeted and planned for that accordingly through our budget, and our investors approved that, of course.
Right. They essentially allowed us to defer it out based on our projections. During the process of being slumlords, we and for permitting, we dealt with the city. We actually almost dropped the ball during the acquisition, but we dealt with the city, we dealt with the state, because for all of these complexes, you do actually need a license through the state to operate as well. Some counties actually will require a county license as well. So you need the proper licensing, you need to have everything, things that a lot of people don't think about, simple things like backflow certs and fire extinguisher certs, just different aspects. So we operated it, we're in the city, we built a great relationship with the city. Actually, we ended up winning an award from the city for beautification. So I don't really know how to describe this, but when we ended up taking the property down, the neighbors came out, they thanked us. The police stopped, they thanked us. It was pretty interesting. And what we did within about 4 months, because development's all about the timelines and getting ahead of the ball and really being proactive versus reactive, which is, I'd say, one of the big differences between developers and contractors. Some people that don't know the industry, they say, oh, you guys know this, and it's not really the case. I'd say the construction side tends to be much more reactive. On the development side, we have to be proactive. So we were proactive, we were able to hit our schedules. Of course, nothing's perfect, and we joke and we say that perfection is the enemy of great, but it's really true. So we took everything we learned and kind of as a lesson, right? So we did have a couple hiccups. We learned how to, unfortunately, react to those, but it made our next project better. We ironed out the kinks in terms of the operational side and literally tracking tenants and what types of tenants. And, obviously there are laws that protect, different types of tenants, but that's not what I was referring to. It was more so, what is the credit rating we want? And there you go. So you guys can see Steven's screen there? Yeah? Yeah. Okay.
And we can see
we really focused on kind of going back to as you can see, those are not professional photos, but we really focused on the credit worthiness of the tenants, similar to you may in a bond, right? So we rated the tenants, and it actually became a pretty strong selling point in terms of the contract, or the property is now under contract. But in terms of the type of people that came along and said, hey, I would love to do this with you on a bigger scale. So this was I'll call it our first baby here. And then simultaneously, and prior, we had actually entered into a PSA, which is a purchase and sale agreement, on another parcel of land, which had been deemed undevelopable by most developers. That one had 5 specimen trees, and the city of Fort Lauderdale was, or is, I'd say was, notorious for being horrible when it came to their landscape department. I know this thing's recorded, so they're better now. But so they promoted the person from within, and I say promoted. They moved her to another building, gave her a different title, and it really. Our project was able to come to life. We did save 3 of the specimen trees. We made them a highlight to the property where most people just wanted to tear these things down. And I don't know if Dr. Forgy has shared any of the professional photos with you, but you'll see it as we come about. But this thing was right in the middle of the site, and we ended up making it around now. So at the same time, we were working on our site plan and kind of working through DRC, and just kind of everything was being proactive and trying to not bite off more than we could chew. At this time, things were pretty calm. Fast forward to 2020 and everything is on top of each other. I think within 2 weeks, we had a grand opening and a groundbreaking on our next project. So I don't want to talk too much. I figured I'd let you guys kind of just ask questions as they come about, and we'll go from there.
Well, I'd like to say congratulations to you guys. I started the program about 6 months ago, and you guys had really just, I think, completed the shell, really. And you guys were kind of, it's funny, you guys were kind of talking about the tree that you guys had to deal with. If I'm not mistaken, you guys did an infill with this second building, right? The smaller building?
So
it was from ground up, right? The smaller building in the back tucked behind the 2 trees here?
So it's ground up. However, there was a community facility there at one point. The community facility was located at the northwest corner and kind of had a pool and everything else. It's now a sidewalk to nowhere, but the community to the west of us has a sidewalk that basically walks into our fence, our perimeter fence on the property now. But it wasn't it's not completely what I would call a true infill. Because it was pretty good land. It just had these specimen trees.
Right. Did you guys?
I think there may be a little confusion there. Sorry to cut you off there. I think there might be a little confusion. The Zen Garden project we're showing previously is completely separated from this. So both buildings actually on this piece of property here, the small one and the big one, were brand new, ground up. This whole property is ground up development.
Okay. That's what I had originally thought too. Okay. What was your guys' biggest struggle with, I would say, the project overall? I was kind of going to say the entitlement process, but what would you guys say was your biggest difficulty with the? Did you guys have to assemble the two parcels here? Were they separate?
So this was one parcel. However, the parcel was not platted. That took, I want to say, about 14 months.
Wow.
No, yeah. So Stephen loves which is kind of the yin and the yang here, right? So Stephen loves the horizontal work. I love the vertical. So I'll let Stephen get into kind of the horizontal and, the process of going through. And right there, you can see that there are some significant trees, and the city was not really hearing us out when we wanted to remove some.
So part of our biggest hang-ups on this property now, that our strategy going in, again, before I get too far here, was the crawl, walk, and run strategy. Again, I came from an institutional background of building 300-unit communities. One thing, again, going back to not knowing it all, is something we definitely admit. I'd be the first to admit, I don't know it all. And I'm not an expert at this stuff. Do I know a lot? I've learned a lot over, for sure, the last 7 years here. But I still have a lot to learn. So with that said, there's a lot of things that we know that we don't know. And, they only pop up as you go through the process. So, Noah hit on one on the operational licenses and being able to operate the property, something that we were not aware of. So, we started out small here at 22 units. On top of, from that same standpoint, mitigating risk, we also were looking for sites that are zoned to right, where we don't have to go through the land use changes and the re-entitlement processes and have to get in front of city council and the neighbors and, them, with pitchforks and trying to, tar and feather you about the project you're proposing. So we're actually allowed to build what we propose here on this property. So with that said, we mitigated tons of risk from that standpoint. And even though we were allowed to build what we were allowed to build, the neighbors still got up and complained and went to the city commission and the mayor writing letters, complaining about what we're doing, telling us it's affordable housing, and we're adding so much traffic to the neighborhood, and a bunch of different things. We even had an excuse from one of the neighbors saying, well, there's a 3rd-story property, and mind you, I don't want to paint a bad picture for you guys here, but this older gentleman, maybe in his 60s, he goes, I'm going to be in the shower with my wife, and the 3rd floor is going to look right into my shower and see us doing our thing. We're like, well, nobody wants to see you guys, first of all. And secondly, sorry, we're allowed to do what we're doing here. I don't know what to tell you guys. So, of course, there's that political game you got to play, and, but we're able to mitigate that risk. Our biggest hang-up throughout the process here was entitlement as far as getting the site plan approved because of the tightness of the site and the constraints. This site is under an acre. We were able to maximize the density. The site was done 25 units per acre, so this site was 0.912, if not mistaken. Per zoning, we're allowed to, build 22 units, and that's what we're able to maximize. With that, there's still a lot of utilities that need to come onto the site to service these 22 units. And, for the fact that it's smaller, it does make it a lot harder to plan, because if you had this at a 50 unit count, we have one tap, one water tap and one water main to service both buildings. If we had 50 units, we'd still have that same water tap and that same water main to service all 50 units. So you guys can imagine how much tighter it gets at this scale of 22 units. So, those utilities do add additional costs too, from that standpoint. So you don't capture effectively a lot of the economies of scale, which we learned the hard way. So the biggest issue we had was, again, planning this thing, was the trees and the utilities that go with it. As you can see from the plan here, let's see if I get a closer one. This was the original plan. We haven't updated this, but you can see we identify a couple of trees that we are preserving. This is the latest plan, by the way. We have one here at the, oh, sorry, wrong screen. This was the final plan we signed up for. We protected one tree here at the front entry, one tree here in the roundabout, and also one tree here in the corner. When we first went into this project, we actually wanted to do townhomes for sale. And unfortunately, because of the trees and the specimens, we could not tear those down. Each tree here was valued at over $50,000. And that just made the project unfeasible from a financial standpoint. So we basically had to scrap the townhome idea, and we had the idea of, if we went with apartments, we may be able to maximize the density or get more of it because we have more flexibility with the parking arrangement. That's what was killing us before with the townhomes, because you needed access in, you need parking in front of each unit, and of course with the trees in the way, it just wasn't possible. So we were able to maximize the density here, and we created the focal point around this tree here and create a roundabout around it. So when you see the pictures of the property, you'll see what we're talking about. It just looks great when it's actually all built up, and it does add a lot of value, and that's all the feedback we've been getting from everyone who's the property. So, that was our biggest constraint, was these trees and going through the engineering and the landscape department of the city. Unfortunately, guys, and this is a harsh reality, when you're planning and you're going through these processes and entitlements through the cities, municipalities, they will talk to each other. It all takes time. You have to prepare your package, submit it, and the departments have 30 days to review before they provide comment. So you'll get a comment from engineering, and you'll get a comment from landscape, and they're not talking to each other. So for example, the trees, there's different trees that we planned in the right-of-way here. Let me pull up a different example to you guys. But simple things, like for example, we have existing utility in the right-of-way. And the right-of-way is the area out here in the front of the property, which the cities usually dedicate to themselves for maintenance and sidewalks and such. So there were underground utilities that service the entire community. So one of the issues that we had throughout the process is that, again, these folks don't talk to each other. Landscape department requires you to have canopy trees or shade trees in the right-of-way. And as you can see, we have 4 nice crepe myrtles here. Previously, they weren't crepe myrtles. They were actually oak trees. And because of the existing utilities in the ground, you can't see them from this plan. That's why it's important to kind of understand all the different layers as it pertains to the planning aspect. There's a lot of utilities that you can't effectively see on this plan. I'm going to open up another one to show you guys. You can see all the different lines that are coming through the right-of-way here. So again, it's hard to see it from this perspective. You got to split through the plan. But once you overlay it, you'll see that it's really hard to plant a tree between all these lines. There's existing sewer lines, there's existing water lines here in the right-of-way, and we had to plant the trees. Oak trees are big trees and have extensive root systems. So the landscape department says, hey guys, you need canopy trees. Please plant oak trees, and that's what we did. We had oak trees in the right-of-way. And then the engineering department comes back and says, sorry guys, you can't have oak trees because you're in between utilities and the root system kind of messed up the utilities. Well, your landscape department, your neighbor, you literally right next door, in the office next to you, told us we can do that. So what do you guys want us to do? So it literally took, setting meetings to grab different folks and sitting down with them and saying, hey guys, please talk to each other. You're telling us to do X, you're telling us to do Y, and it doesn't work. We need some clarity. So finally, being able to get in front of these people, put them in the same room, we were able to come to a resolution and propose different trees that work, which ended up being the crepe myrtles with some type of root barrier to protect the underlying utility system. So This is just one example, by the way, guys, and there was many of them. And this was our biggest constraint as far as being able to plan this thing. It took way too much time and energy to actually go through the process here for these 22 units, just because of that perspective. So, you know, that was probably our toughest challenge. And going back to, you know, folks thinking they could do this on the side as the part-time gig. I mean, how do you go to the city at 6 o'clock at night or on the weekend to resolve these items? I mean, you can't. You have to do this during the day. You have to sit down with people. I'm not saying it's impossible, but it does make it a lot more challenging. So, you know, this took full-time effort to really push it through. And, you know, we're all about getting in people's faces, you know, making noise when we need to. And that's what we did to get this thing pushed across. And, you know, at first, I think the city was a little frustrated by us because, again, we were that type, you know, out there knocking on doors. But after the fact, I think they appreciated the fact that we were very proactive and on top of these things. And now they enjoy working with us. And we're now at our second project with the city of Fort Lauderdale. And we can elaborate a little further on that. But I'm happy to answer any other questions on this project specifically. Do you guys have any?
Well, was this particular project located in a CRA district?
No, you want to chime in on that one?
Sure, I was just responding to some questions here. So this one is not within a CRA. I believe Fort Lauderdale has the northwest along I don't remember what it's called, but they have, I believe, 3 of them, and this one is not. And, you know, I think at the time that this was happening, they were actually, a lot of the CRAs were sunsetting. California had passed some legislation as to whether or not CRAs are actually beneficial, right? Because if you guys are familiar with how TIF money works, I'm not sure, is this the first semester here for you guys?
Yes.
It's mixed. Some are a little bit later, some are newer.
Okay. So, you know, they had actually been discussing about getting rid of CRAs in general. We did not seek that. We also knew, because, I guess I'm jumping all over here, but we knew that because what we pro forma, where our rents would need to be, it most likely wouldn't be a CRA, I guess, incentivized project. And you can ask me for clarity if I didn't answer that for you.
Thank you. Another question on the parking aspect of for the project. Did you guys have to get the code lax to allow you to reduce parking, or did you have adequate number of parking for this particular project?
We have 42 parking spaces. We do have direct access garages. There's 5 of them. And in front of those direct access garages, meaning pull into the flat, which would be the first floor unit, and you can actually just walk right into your unit from the garage. There is an entryway, which we deemed tandem parking, essentially. But the city of Fort Lauderdale does not count that. So we have an abundance of parking, yet because we saved 3 specimen trees, we also, there was a section of the code that allowed us to have, I believe it was 2 parking spaces reduced. But either way, the site parks well.
Okay.
So realistically, there's 47 parking spaces and 2 of those are handicapped.
Another question, I think someone asked a question earlier about the parcels being contiguous or separate. Did you guys have to plat the property, or was that something that you are considering to raise the value of that particular parcel?
So yeah, we had to plat the property. That's what took I'd say the most time. It was about a 14-month process. You're dealing with Broward, you're dealing with the city. You know, you have to get X, Y, Z done at the city, and sometimes you can't run them, you know, concurrent with each other, the processes. So that took a good 14 months there.
To piggyback off James's question about the assemblage of the properties, and also to comment on the comments in the chat, I'm curious, not to talk too much in detail about this specific property, but if you guys would recommend how much do you guys put up for the purchase and sale agreement of your own money typically, like 2%?
So
what would you recommend, I should say?
I can't really recommend anything because I can tell you that we've put up deposits that are pretty heavy, or proposed deposits that are pretty heavy in some instances and which are light in others. You know, I think we made an offer recently with a partner. It was about a $56 million deal or so. And, you know, I think our deposit structure was less than $300,000. So, you know, but for a small deal like this, they're not going to want to tie it up for, you know, on a proportionate share of that.
Moving forward, do you guys see the trajectory of your company going more towards infill or value add based on the 2 projects that you guys have done so far?
So that's a good question. I think, and by the way, we do have a for sale product as well, which we broke ground on. So I think it's more so market driven. I say that because right now we're in the crawl stages, right? So our company's just over 3 years old. I always say we're at the infancy, right? So we're doing value add multifamily, ground up multifamily, and then we've got for sale luxury fee simple product. In saying that, we're building our track record so that with investors we can adjust to the markets as they come. So I think it really depends, right? So if we can do a value add project and we can hit the same rents and have a similar disposition as we would on a brand new construction project, then, you know, that's potentially something we would do. But right now, you know, and one of the major things, and I think without getting too far into it, but one of the major things that any purchaser of this type of asset looks at is the OpEx, right? Because the OpEx, it dictates the cap, essentially. It's a huge number. So OpEx might be 35, 32, 38%, you know, depending. So insurance is a huge number in that. Insurance, taxes, those are big numbers. So depending on the, I guess, the property type and just the financials of the deal, you know, we would have to adjust, you know. We are, I'd say, you know, they have a saying, and we're kind of learning as we go here, but I think the saying goes, you want to be the first child, the second wife, and the third developer. So, you know, we're learning that we over-improve things to a certain extent, but at the same time, we're proving our track record, right? We're gonna most likely, and I can't validate this just yet, but on a price per square foot basis, we're gonna set a record in Oakland Park when we sell Zen Garden. On our Palm Air project, we're gonna operate it, season it, meaning just really run down what our numbers are, what the project financials are from an operational standpoint, not from a development standpoint. And then we're gonna end up selling that project as well. And, you know, we'll probably break records for that area because, and I sure hope so, right? Or we won't be on these Zoom calls. So it's the only new product there in a very long time, I think since like the 70s or 80s. So there's no reason we shouldn't. But if for some reason the market says, hey, people don't want to pay this much and you can actually acquire existing multifamily for less, then that's something that, you know, we would look at as a value add opportunity. Right now, the single family home market is killing it, and, you know, that's something we would also look at.
I have another question. Well, what method did you guys use to tie up the property? So when you first saw it, and in order for you to do your feasibility study on that property, how did you go about tying up the property without putting too much money into the property?
Well, you have to put money in, or nobody's going to give you the time of day. But having what I would say are intelligent conversations first definitely helps. And once you kind of put depending. So money where your mouth is, you know, it helps. You know, just so that you're aware, even to get into a PSA, you're probably going to spend, call it, $5,000 in legal fees. So that's the intent of the LOI, which is a letter of intent, is so that you can kind of hash out a lot of the items prior to entering into PSA, so that you can really minimize the legal bill as it comes about, because you hammer out a lot of the terms, right? And we see a lot of LOIs, you know, they might be a page or something. Ours are very formal. They tend to usually be a few pages, and they hammer out all the main talking points. And, you know, I think the presentation is crucial, because when we see sloppy LOIs or sloppy presentations, we probably take them less seriously.
Hey, Steve, I'd like to ahead. Sorry, go ahead.
Yeah, just a quick question. Being a new development company, how often do you guys use tools such as GIS and Argus? And you know, how often, or if so, do you use those tools?
So I'll chime in really fast, and then I'll let Stephen go off on Argus here, which is when it comes to GIS and all those things. And if Professor Worse is on the phone, I hope he doesn't take this the wrong way. So we just reach out to the brokers and we say, look, send me the pop stats on this, which is a program. Send me this, send me that. You know, send me the CoStar, send me the axiometrics, and we'll give them locations. And you know, we don't actually use those tools. We just call the brokers. So we've got relationships with a lot of the institutional brokers. You know, the Jones Lang LaSalle's, which acquired HFF. You know, Newmark, or it was ARA Newmark, but Newmark Knight Frank, now Newmark. So you can literally just reach out to the brokers and say, hey guys, I need information on this. Here's the criteria. Please send it. And, you know, any broker worth his weight will send it to you, or they actually have analysts that send it over to you.
Or fee?
No.
No.
In reference to the Argus, you know, each company, of course, has their specific procedures, processes, and they have the tools that they use. When I was at the development companies, for example, they use the apartment developer, and we also use spreadsheets. You know, us internally, we, of course, running lean and mean, we do not have the resources to, you know, purchase all the additional software, so we use spreadsheets, and spreadsheets do the job. You know, we do a lot of checks and balances to make sure that, you know, one spreadsheet is playing well with the other, and that you know, everything that all the information we're looking at is correct and accurate. So that's what we use, and a lot of developers use that as well. Argus is a tool that is specific to some groups, either a developer or management company. So it all depends on, you know, which group you're working with and what tools they use, of course. But Argus is a powerful tool. It just depends on, you know, who's actually using it.
I have another question. Going back to my question about tying up the property. What was the due diligence period? So you tied up the property. What did you give them as far as a due diligence period before you made a decision to go or no go?
So I don't remember off the top of my head. You know, I believe we were pretty aggressive, given the fact that there are so many specimen trees on the property. And I want to say it was about 60 days due diligence. It was either 45 or 60. Now due diligence periods are longer, and you know, depending on the complexity of the site, the different sellers, depending on the knowledge that they have, and if they have a broker, the representation they have, will allow longer due diligence periods. You know, we've looked at projects that include filling in a lake and depth studies, and you know, you need an underwater survey essentially, and you know, it takes a lot more time. And then in a situation like that, you're going to need a longer due diligence period. If there's brownfield and there's remediation that's required, you need a longer due diligence period.
So guys, even though we have these due diligence periods in the contracts and, even making offers on these properties, it's important to get ahead of these things, especially starting off as a new developer. Noah mentioned the fact of ironing out all the kinks in the LOI. That's something that is easily put together by an individual versus an attorney. Of course, it's good to have your attorney review it because that's where you are negotiating terms, but you're not really floating a big legal bill when you're generating the LOI. So the same thing with the due diligence, for example. Before we even get into contract or even entertain that, we have good relationships with our architects and engineers, and we definitely recommend and suggest you start creating those. We are able to reach out to them for quick feasibility questions, studies, and for them it's goodwill, right? They're willing to do a quick study for you. It doesn't take them too much time and effort, but these guys are very knowledgeable in the local areas. Will tell you what their concerns is, what the constraints are, whether they think this is feasible or not. So we'll run around a lot of these items ahead of time before spending any dollars. So, when we're in the due diligence period, now we have all our proposals lined up. We know the project for the most part works. So we have contracts pretty much in place. So when we sign that dotted line, it's, releasing the hounds pretty much. So all the engineers and architects, they get to work immediately. We're already having a foundation, a baseline, so we try to be as efficient as possible throughout that due diligence period, to try to capture as much economy that we can throughout that little period we have in case there's any unexpected circumstances that pop up and we have to walk away from the contract. I'm sure you guys learned a little bit about contracts, but the first deposit is refundable during due diligence. So it is important to run the ground as much as you can during that period and figure out if it's a go or a no-go decision before your money goes hard. So once your due diligence period ends, that's when you have to put up your second deposit, and those both are at risk at that point. So if you're moving forward from that point, you have to have a good understanding of what your project entails. If not, you have a lot at stake to lose there. And, you don't want your investors chasing you around all night trying to get their money back. So that's something very important. So, we are very proactive in that sense, and we try to run everything around ahead of time. So, that's something that is possible. Again, not everything is achievable in that sense, but you can do as much as you can to get ahead of things and doing your own research prior to, spending significant money on trying to get these things pushed across.
So,
And just
go ahead.
moving forward, if you could just tell us your name when we're speaking, and you might have, maybe I missed it, it'll help because I'm taking some notes on the side just so that, if questions come up later, and we're happy to provide contact information, or I can, probably might not answer when you call, but if you get questions that come about throughout the process.
I'm sorry. My name is James. James Duke.
Okay.
So one of the things that obviously we have spent the past 2 weeks talking about in the class is about deal structures and also about ownership structure. Could you guys, to the extent that you feel comfortable just talking either generically or specifically about some of the things that you've dealt with as it relates to both of those, and I think that would be really useful.
Sure. So I can talk about kind of, without getting too intimate with the way we structure deals, I can kind of talk about just top level how a lot of deals we do know are structured. There's an equity component, being, call it investor money. There's a debt component being the banks, and once in a while there's like a mezz component, which fills the gap somewhere in between. We put up a small amount of the equity component. We then find an investor who also puts up equity. We might put in 10% of the equity or 20% of the equity, however you want to cut it. But I think most standard, or what's typical, is about 10% of the equity contribution. Equity typically plays out to be about 35% of the project. However, now, I can't even say post-COVID, but now during COVID and potentially past the initial surge, they've required more equity going into the project. So it might now be 40% equity or 45% equity because the lenders are really trying to mitigate their risk. And a lot of the equity groups that would used to want to stroke you a check and say, here you go, we're gonna make 20% IRR or whatever the case may be, they've now shifted to a preferred debt position where they say, hey guys, you come up with 13% of the project and we're going to finance 87%, but it's debt and we're going to have the superior, essentially a superior lien on this thing.
Okay.
And feel free to.
So now on the ownership structure side, I mean, can you, I guess, tell us a little bit about, in terms of the type of ownership structure, in terms of, did you do it as a partnership? Did you do it as a joint venture? Did you do it as a limited liability company? How did you set it up? And do you have special purpose entities or single purpose entities for each of the projects? So kind of walk us through that a little bit.
So there are. What's that? So pretty much we have our holding company, which invests into a joint venture with the investors, and then from there they have a property level entity. So they are all SPEs, except for the holding one. So there will be us and our partner in a JV agreement, a partnership LLC, and the partnership LLC will have ownership of the property level LLC. So for example, our Palm Air project is under Palm Air Preserve LLC, but then there's Palm Air Preserve Partners LLC, which is the ownership essentially of that LLC. And I'd say it is best to have these SPEs. We've had we can tell you the good things. There's some bad things, of course, but as we grow, it's part of this industry. And the SPE is absolutely a way to protect yourself. And we've actually had it where if we wanted to go after an SPE on a litigious issue, they didn't have the assets for us to go after. So it protected them in that instance.
Taking a couple steps back here, and more specific example to how we operate with Palm Air here. Defined companies, that is the holding company, and the developer is defined development. We market defined companies, and again, that's our holding company, but the developer who takes on all the liability, pays all the expenses for the company, is the development company. So they take on all the liability, and that's who we sign our other contracts for. During the due diligence period and prior to actually taking ownership under SPE. So any liability that occurs is with defined development. That way it's separated from the holding company, which is tied up in multiple investments in different projects. Defined companies itself is the entity who actually partners and owns portions of the project. So Palm Air Preserve LLC is the underlying owner of the property at the property level SPE. And defined company, or there's a partnership level after that. So Palm Air Preserve Partners LLC owns the property level 100%, as Noah indicated. Defined companies is part owner and manager of the partner level, and that's where the other investor comes in and has their percentage of ownership. So 100% of the property level is owned by the partner level, and that's how you delineate the liability. So if anything were to happen at Palm Air Preserve, there's a lawsuit and someone's coming after us, we're protected because of the different chains of entities and ownership. Defined companies is separated from the property, likewise the investors, and of course, at that point, that is a specific partnership and investment vehicle that is kind of segregated from everything else. So we can still operate and define development on the property and, not have commingled assets, under liability being that it's all separated.
The partnership pays development the fee.
That's correct.
Development is hired by we'll call it JV LLC, will hire defined development to be the developer on the project.
And of course, the partnership would go raise debt, and that's where the lender and the construction loan come into. And of course, it's all specific to the market. And also the location and the finances, of course. But as Noah stated already, typically the lender would pitch in about 65% of the total project, and another 35% would be equity, which the equity is that's where the partnership level comes from, right? How much of that 35% does the defined companies own, and how much of that 35% of equity does the partner own? And that's where everything is distinguished.
And if you guys have talked about promotes, that's where really the promote happens, because that's going to get paid the debt. And then the equity is really where the promoted interests come into play.
So our deal is, sorry, Jeff, go ahead.
Can you guys elaborate a little bit more on, or elaborate on construction loans and your takeout loan, and what was the process? Were you guys able to find a mortgage lender prior to the TCO of the project, or did your construction eventually become your primary mortgage lender as well?
So we definitely communicate with the lenders way in advance. When we're planning these things and we have our kind of estimates from our construction, it's important to deal with the contractor very intimately, so they understand what your project is. You have legitimate costs and forecasts, because there's a lot of moving parts. Every time you make a plan change, it affects multiple layers in the pricing as well. So, you start with a preliminary budget, you set up your pro forma in that sense, you start teasing the market, both equity and debt. So at that point in time, before you even break ground, you're already talking to your lenders and trying to get some type of feedback from them. And then once you solidify your numbers and you're at like a final pro forma per se, then you can start engaging lenders and receiving term sheets. And the term sheets themselves identify exactly what the rates are going to be for the project as far as the financing goes. So of course, once you pick a horse, you sign up with the lender, and Noah will be the first to tell you the lending process and screening is so much fun. It's like 400 pages of legal documents. So buy yourself a new set of eyes. So when you start reading those things, Noah, you can chime in on that. But Noah is, again, we wear many hats. He's our in-house attorney, and he's very well versed in the legal and documents. So he does take the lead on those things, and those are very strenuous. So it's good to have a good counsel at your hip and really understand these documents, because you're pretty much signing your life away in those things. You got to understand what you're signing up for. There's different things in those agreements that could come back and bite you in the butt. For example, there was talks recently of moratoriums in Fort Lauderdale because of all the infrastructure issues and all the growth that's happening in the city. So there were talks with the city that there could be potentially a moratorium. At the time, we really fought hard with the lender to eliminate the language of moratoriums. And the lender's response was, there hasn't been a moratorium in, I don't know what he said, 20 years in Fort Lauderdale. That's not going to ever happen. So that's something we kind of acquiesced to. And it is in the agreement. And of course, during the process, when we heard those talks of moratorium, it scared us. We, of course, wanted to put that into the agreement, but the lender wouldn't have it. And, that's one of those risks that you take when you're doing these developments. Luckily for us, that didn't happen and we were able to finish our project. But again, that's just one example of the many things that are in those agreements. And Noah, you could elaborate a little bit more on there.
So yeah, Stephen, throughout the term sheet language, essentially, and that's the banks, essentially the bank saying, here's our LOI, and this is going to be what it is. And then when you actually sign up with them, you typically pay, call it a $5,000 fee, which will get rolled into the closing costs. But I mean, I don't know if you guys know this, but we pay our attorneys, we pay the bank's attorneys, and by the time it's done, you're, call it, I don't know, $50,000 depending on the loan, right? So you could be $30,000, $50,000 just in legal fees because you're paying their attorney and we're paying our attorney. Our first loan doc that we went through was, well, I shouldn't say loan doc because it's composed of multiple documents, including, partnership level guarantees and different aspects. It was 496 pages of just legalese. We almost went blind, I'd say. We ended up buying the blue light protectors for our monitors, and it got to the point that I would say we were almost delirious and enjoying it. So brought some, I think Stephen brought a bottle of Cuban rum in, and just started, drinking, enjoying it, and reading these documents. But that's not our standard practice. That's just at a certain point you lose it. But
I'll tell you what, halfway down that bottle, the document got a lot easier.
So about that loan, or those loan docs took about 6 weeks once we had them in our possession of strictly reading, and they give you a checklist with, I don't know, call it 100 items that they need. Maybe 40 will be project specific, and then a lot of the other things are they want to see personal financials, they want to see partnership financials, they want to see org docs, they want to see everything else, and then also signing off on the different legal documents that come about. And that process was our first, construction loan as a company. And because Zen Garden was done with equity, we paid a premium, but we wouldn't have been able to vacate a property because we vacated the property to do the work there with the bank loan. So it took about 6 weeks, and our next construction loan, given that it was with the same lender, so the process, we were familiar with, what can I kind of push on and what extra things should I push on knowing they'll say no to so that I get something else that I want. That one took about 3 weeks. So we were able to get through the legal docs much faster the second time around. Feel free to ask kind of what kind of triggers and crazy stuff they have in there, but if you can think of it, it's in there. And just so that you guys are aware, we signed away crazy stuff when we got into business and guarantees. And look, none of us can, well, Stephen and I can't guarantee these projects ourselves, but we signed away that, if we have livestock that, our partners are entitled to the birth of their, future livestock. They can take trees of value from us. These are real things. So we pour our hearts and souls into this stuff because, everything's on the line.
Yeah, we always tell the lender and they get a kick out of it. Like, hey, we'll guarantee whatever you guys want. We all know that doesn't mean anything. So, while we're going through this process too and reviewing all these documents, the lender themselves, they're reviewing all the documents as well. They're doing their screening and due diligence, reviewing our plans, right? Reviewing our plans against the construction budget, which is called the planning cost review. So there's a lot of things that are happening in tandem on both sides of the spectrum here, where they're qualifying whether or not the costs on our budget will meet the needs of the actual plans, and whether or not we'll be able to build it per the budget that we're allocating. So that's a very strenuous process. They have a third-party plan reviewer doing that. So, you're trying to close this construction loan once you sign the term sheet within 60 days. We all know time is money. If things drag out, it's only going to cost you more, right? You're either carrying the land at that point, or your contract's about to expire on your PSA, you have to close on the land. So, you don't want to pay extension fees and such, so you have to get all this stuff done within those 60 days. The lender will do everything in its power to slow you guys down. So you have to be on top of them, on top of their attorneys, and just following up and providing all the information on their checklist as soon as possible. Because the longer you take to provide it to them, the longer it's going to take them to review it. So during that time, they have a lot of questions. Hey, questioning X, Y, and Z, and you have to provide documentation for each one of those items. So it's really good to be organized when you guys are going through these processes, know where all your documents are, because when they get requested, it's as easy as just drag them from one folder into the next. And luckily we're able to do so in a good fashion and in a timely fashion, that is. So again, there's a lot that goes into it, and once all the check boxes are checked on the lender's checklist there, we do get to a closing date finally. And while we're again, I mentioned it earlier, when you're out there teasing the market with equity and debt, you have your equity partner now lined up. You're not going to facilitate a loan without any equity in place. So you have to have all your internal operating agreements all generated as well at that point in time. Part of the lender's checklist is those operating agreements. So if you don't have that ready, then you're just going to delay the process. So everyone's signed up, all the check boxes are closed, you set a closing date, the funds come in, you sign a notice of commencement at the closing, and once you receive the funds, you are ready to go, and start rocking and rolling on the job site. So trying to sum it up here, it's a lot of items that entail this whole financing aspect. But it takes a lot of coordination and a lot of patience as well. So you guys have any extra questions on those?
How did you go about getting other investors in?
Having trouble hearing you on this side.
How did you go about getting other investors in?
How did you basically find your investors?
So the first people we reach out to, as I'm assuming anyone, right, you have to reach out to prior relationships, the friends and family, and that's really the basis. Then once, I can tell you and we haven't even talked about that project, but So Zen Garden, Friends and Family, Palm Air, Friends and Family, also banks, right, or a bank there. When it came to Lake Ridge is a luxury townhouse project that we have next to the Galleria Mall in East Fort Lauderdale. That one was kind of crazy. We anticipated breaking ground March 31st of this year. I think it was March 16th was a pretty crappy day for us. The stock market took a major hit. Our investors pulled out, and it was back to the drawing board. And we had permits ready, and we were ready to go. And banks stopped lending. Investors, like I was saying, they didn't want to invest. So we put together a brand new, it essentially would be a PPM, but we'll call it an equity teaser. And we sent it off to everyone that we could think of that potentially would want to invest in this project. Including, it went to shell guys, meaning, and if you guys, I'm not sure how much about construction but shell's a major component. That is the vertical structure, the concrete, and just the going vertical part. We sent it to shell guys. We sent it to site work guys as well, and even talked about them potentially rolling their portion in so that we could raise money because the equity requirement was much higher. And, lenders do not like for sale product. You have to have a pretty solid track record for them to want to finance you, right? Because everybody remembers what happened in the financial crisis. Real estate took a major hit, and the for sale side was really heavily impacted. So there is the reality that homes don't sell. Townhomes don't sell, condos don't sell. But the reality is, if you price apartments right, you're gonna rent them, even if temporarily they're at a short-term loss, but potentially covering a portion. The bank isn't just taking the asset back. So they look for, cash flowing assets, and it was very hard to get